Checkpoint Software Q2 2025 earnings, key financial results, growth insights. Surging ahead in the cybersecurity landscape, Checkpoint Software Technologies Limited has just revealed its financial scorecard for the second quarter of 2025, and the numbers are making waves. Curious how they pulled it off despite tough market conditions? Let's dive into the details that have everyone talking. Impressive revenue growth, but here's where it gets interesting. For the quarter ending June 30th, 2025, Checkpoint recorded total revenues of $665 million, representing a solid 6% increase compared to the same period last year. The products licenses segment was a particular standout, climbing 12% year over year to $132 million. Security subscription revenues also saw a healthy rise, up 10% to $298 million, suggesting ongoing demand for scalable, flexible protection solutions. Meanwhile, calculated billings reached $642 million, a 4% uptick, and the company's remaining performance obligations, RPO, an indicator of future contracted business, grew to $2.4 billion, also up 6%. On the profitability side, GAAP operating income reached $204 million, accounting for 31% of total sales, whereas non-GAAP operating income was even stronger at $271 million, or 41% of revenues. Earnings per share followed suit, with GAAP EPS at $1.84, 6% above last year, and non-GAAP EPS came in at $2.37, growing by 9%. Leadership Insights strategic moves. CEO Nadav Zafrir attributed these gains to robust performance in emerging technology sectors such as email security, secure access service edge, SASE, and enterprise risk management. Quantum Force Appliances reportedly maintained double-digit growth, reflecting strong market trust in Checkpoint's preventive approach to cyber threats. But here's the part most people might overlook. Checkpoint's acquisition of Veriti further bolstered its Infinity platform, emphasizing an open and integrated security ecosystem. Early indicators from July suggest a promising third quarter, and management confirms a strong deal pipeline heading into the latter half of the year. Yet some critics ask, does such aggression in expansion dilute the company's focus, or is it a necessary play to stay ahead in a fiercely competitive market? Financial update. What's behind the numbers? Checkpoint ended the quarter with $2.91 billion in cash, marketable securities, and short-term deposits, down from $3.06 billion a year earlier. This decrease mainly reflects the investments made in acquiring Cyberint Limited and Veriti Limited for a combined net outflow of $270 million across 2024 and 2025. During Q2 2025, the company repurchased about 1.5 million shares, returning roughly $325 million to shareholders. Operating cash flow was $262 million and included a $50 million boost from currency hedging, offset by $6 million in acquisition-related expenses. By comparison, Q2 2024 cash flow from operations was $200 million, weighed down by $14 million in hedging expenses and minimal acquisition costs. Understanding the jargon, billings RPO, calculated billings combines recognized revenue and the change in deferred revenue during the quarter. Remaining performance obligation, RPO, refers to future revenue the company has already secured through contracts but hasn't yet recognized. Think of it as a pipeline of guaranteed future business. Investor access upcoming events. Checkpoint invites interested parties to join its Q2 results conference call and webcast on July 30th, 2025. The company's leadership team will also be connecting with the investment community at several major technology and finance conferences, including those hosted by Oppenheimer, NASDAQ, Deutsche Bank, Citi, Goldman Sachs, Jefferies, and Piper Sandler, spanning locations from New York to Tel Aviv. Conference details and webcasts are available on Checkpoint's investor relations page, but dates and formats are subject to change. A quick snapshot. What drives Check Point? As a global leader in AI-powered, cloud-centric cybersecurity, Check Point protects over 100,000 organizations worldwide. Harnessing artificial intelligence with its Infinity platform, the company delivers anticipatory threat defenses, rapid response times, and coverage that includes workspace, cloud, network, and collaborative security services. It's a compelling proposition in today's digital-first economy. Legal perspective. Proceed with caution. This update includes forward-looking statements, that is, projections about future events or performance that are inherently unpredictable. There's a clear warning. Actual outcomes could differ, owing to factors like competition, customer demand, technological shifts, or broader political and economic challenges. Investors are encouraged to review Check Point's regulatory filings for a more nuanced assessment of potential risks. A note on non-GAAP reporting. Check Point supplements its GAAP results with non-GAAP figures, which remove stock-based compensation, amortization, and acquisition costs, aiming to give investors a clearer picture of ongoing business health. While such adjustments can be helpful, some skeptics argue they may mask true business pressures. What's your take? Over to you. Is Check Point's expansion the right call? With double-digit growth in key business areas, headline acquisitions, and a robust financial showing, is Check Point setting the gold standard for cybersecurity companies? Or could they be taking on too much? Do you think their strategy is a recipe for sustained leadership? Or do you foresee risks on the horizon? Let us know in the comments. Where do you stand in the great cybersecurity debate? Check Point Software's strategic independence amid rising cybersecurity sales. Imagine a world where cyber threats are on the rise and companies are scrambling to protect themselves. This is the reality we're facing today. And it's a stark reminder that the need for robust cybersecurity measures has never been more pressing. But here's where it gets interesting. While some companies are opting to join forces with others to bolster their defenses, Israel's Check Point Software is taking a different approach. The company's CEO, Nadav Zafrir, has made it clear that Check Point is not looking to be acquired by another company, unlike some of its local rivals. Instead, the company is choosing to go it alone, using its substantial cash reserves to make strategic acquisitions and drive growth. This decision is particularly noteworthy in light of recent developments in the industry, such as Palo Alto Networks' acquisition of CyberArk Software for a staggering $25 billion. But Check Point is undeterred, with Zafrir stating that the company has a clear strategy to become the #1 player in the world. So what does this mean for the future of cybersecurity? And how will Check Point's decision to fly solo impact the industry as a whole? To answer these questions, let's take a closer look at Check Point's recent performance and its plans for the future. The company has just reported a second quarter profit, with earnings of $2.37 per diluted share, excluding one-off items. This represents a 9% increase from the same period last year and is broadly in line with analysts' expectations. Revenue also grew by 6% to $665 million, slightly exceeding forecasts. But what's really driving Check Point's success is its product and license revenue, which rose by 12% to $132 million, and its security subscription revenue, which gained 10% to $298 million. Zafrir attributes this growth to the company's strong pipeline and healthy indicators for the third quarter. In fact, Check Point is estimating revenue of $657 to $687 million for the third quarter, which would represent an increase of up to 8% year-on-year. The company is also maintaining its 2025 revenue projection of $2.66 billion to $2.76 billion, an adjusted EPS of $9.60 to $10.20, which would represent growth of up to 11% over 2024. But here's the part that's really worth noting. Check Point is not just relying on organic growth to drive its success. The company is also using its cash reserves to make strategic acquisitions and buy back its own shares. In the second quarter, Check Point bought back 1.5 million of its own shares at a total cost of around 325 million. So what does the future hold for Check Point and the cybersecurity industry as a whole? Will the company's decision to go it alone pay off? Or will it ultimately decide to join forces with another company? And what do you think about the recent surge in cybersecurity acquisitions? Do you think it's a sign of a growing trend or just a series of one-off deals? Let us know in the comments. As the cybersecurity landscape continues to evolve, one thing is certain. Companies like Check Point will play a critical role in shaping its future. But will they do so alone or as part of a larger entity? Only time will tell. And this is the part most people miss. The fact that Check Point's decision to go it alone is not just about the company itself, but about the broader implications for the industry. Will other companies follow suit, or will they opt for a different approach? The answer to this question will have far-reaching consequences for the future of cybersecurity. But here's the controversy. Some people might argue that Check Point's decision to go it alone is a risky move, especially in a rapidly changing industry like cybersecurity. Others might say that it's a bold and necessary step to drive growth and innovation. So, which side of the fence do you sit on? Do you think Check Point's decision to go it alone is a smart move or a recipe for disaster? Let us know in the comments.